Welcome to Your Personal Bank Show. Today, I want to talk about some of the recent questions and uses of your personal bank. Some of these you may have heard of, but I keep getting asked these same questions often enough that I think it's worth repeating, if nothing else. And let me just give you a couple quick examples. For example, some recent cases where folks, how are they using this? You know, if you listen to some of the previously recorded shows, you would have heard like the Gary McDermott interview that I did recently. He uses his for real estate investing. That's probably the most common use of it. In fact, I have a client, a prospective client, I should say, I was speaking to today. And he was talking about, well, he's inheriting some funds and he's planning to purchase, he wants to purchase a property. And I said, you know, you've got a choice. He's got the funds coming in. And I said, you can, of course, purchase that property, obviously. And, it does what it does, right? He's looking at, as an investment property. Or you can put the money in the personal bank policy, earn the dividends today, between 5.75 and 6% dividends today. And again, we have companies been paying those types of dividends every year for the last 25 plus years and have never missed a dividend since, well, literally before the Civil War. I know I keep repeating myself on that, but, I think it's valid and important to do so. So often I hear from folks, they'll say, I heard you talk about that on the radio. The dividends that are being paid, for such an extended period of time. I had no idea that there were companies out there that had been doing that. And it's because I keep hearing that from folks. That's why I keep repeating myself and letting them know that, gosh, like I said, there are companies that have been paying these kinds of dividends for well over 100 years, never missed ever any single year, including times like the Great Depression, for example. So I think that's powerful and that's important to understand and realize. And again, these you can grow the money tax-free. There's downside guarantees. There's safety built in. So when you look at a 5.75, 6% dividend rate, like today, for example, even today with the low interest rates that we're in, historically low, some of the lowest interest rates our country has ever seen, literally, that's powerful. And when you compare that to something in terms of taxable versus a tax-free, look, depending on your interest, your income bracket, a 6% dividend, for example, could be equivalent easily to an 8% taxable return. Sometimes more than that, again, depending on your tax bracket. So it's very significant, more than many people even realize. I know I got off on a tangent there, but I think it's important. I'm going to touch on this further because this thing about, we'll get back to the uses of your personal bank in a minute, but I think this is so important I can't give it away from this. One of the other big questions I get all the time, and that's really what I want to talk about today, main questions and uses of your personal bank, is, okay, I get that the dividends are getting around, 5.75 to 6%, depending on which company we go with. I get that they've been paying that historically, never paid less than that in the last 25 years, frankly. So they've been paying that or more. Interest rates are really low. I can access the funds from bank line of credit, and depending on the amount of funds and what we're dealing with, we're looking at 3 to 3.25% interest on the bank lines in most cases. We do have one that's 3.95 for smaller cases. But my point is, if I'm earning the dividends of 5.75 to 6, and I access the money and I'm getting charged probably around 3.25%, that's a 2.5 to 3% positive arbitrage when you access the money. And that's exactly correct. Folks, I'm telling you right up front, right at the beginning, basically, of the show, that's the true power of your personal bank, this whole concept, the whole idea of using the high cash value policy to maximize dividends. We're not using insurance for death benefit protection, so to speak, so much. It does have that. But the primary focus and goal here is to grow your money, grow your dividends, earn dividends. And if I lose somebody or they miss the point, it's because they get hung up on the traditional use of life insurance and don't realize that there are other ways, other things that these policies can do, especially these high cash value policies. And these are truly high cash value policies. What I mean is day one, 50 to 85% of the money is available. Day one, through your bank line. And remember, the bank line is the key. The combination of the dividends earned and then accessing the funds through the bank line and getting that positive arbitrage. That's the key power. Because, folks, here's the big secret. I'm going to let it out of the bag early this time. The secret is real simple. That's on money you spent, on dollars you used or allocated elsewhere. In other words, those dollars are not in your pocket anymore. They're not in your control anymore. They're not in your account even anymore. Well, they are. Again, you fund the policy to earn the dividends, get paid the dividends, again, 5.75 to 6%. Then when you access the money, I always ask this simple question. Are you accessing it from the bank or the insurance company? And the answer, again, is the insurance. I'm sorry. I was backwards there. The answer is the bank. You're taking the money from the bank. The cash in the policy is collateral. In fact, one of the interviews I did recently, with Russell Bolton with Coastal States Bank, and if you haven't heard that interview, I strongly encourage you to go to our website at yourpersonalbank.com and listen to it again, because it's such a great interview. It's one of the best I've ever done. All I do is ask Russell about all the different questions about how using the policy and the bank line together in conjunction, how this enhances your financial situation, how you create the positive arbitrage. And again, positive arbitrage is not a complicated word. It's just you're earning more than you're getting charged when you access your money, so you're keeping the difference. And the difference, like I said, right now is around 2.5% to 3% typically in most cases. But what is it like historically? That's what I was getting at. And I get asked that question a lot. And here's the cool part. One of the first things I show people when they meet with me, and by the way, if you want to do so, contact me at yourpersonalbank.com. You can schedule a time, no cost obligation for us to meet, and online or whatever, and I can share with you how this works. But one of the first things I show people is the historical dividends of what all these different companies have been paying. You're going to recognize many of the names. They're household names. There are companies that have been around, all of them, well over 100 years plus. Many of them, again, never missed dividends since before the Civil War. But you're going to see companies paying 6% dividends or higher every single year. Okay? So that is powerful. That's important to understand. Now, what's also important to understand, why I show this historical dividend chart, is when we go back in time a little bit, the interest rate environment we're currently in, and I've heard some say this is the lowest interest rate environment since 1787. In other words, the history of our country. That's powerful. That's significant. But if we go back to, that's been going on, frankly, since 0809. So the last dozen years or so, we've had one of the most historically low interest rate environments in history. So the positive arbitrage makes sense, it works and all that. But what about when interest rates are different? Well, that's why I show the historical dividend chart. And here's what it shows. Prior to 0809, all the companies, for the most part, were paying 7 and 8% dividends. That was the norm. In fact, 8 was sort of the norm. Today, it's more like high 5s or 6. Some companies paying less than that even. My point is, not the companies we recommend, I should say. The ones we recommend are paying 7.5, 7.5, 6% plus, okay? Still, today. But they were paying closer to like 8 prior to 0809. Why? Well, it's simple. Dividends are highly interest rate sensitive. Bank lines of credit interest is also, likewise, highly interest rate sensitive. So in other words, they tend to correlate. And historically, they've done so, and we can show you the history of the correlation of the interest rates. When interest rates were more normal, the dividends were more like 8%. Okay? The bank lines, typically, they're set up where they're based on prime minus 0.5% or minus 1%, depending on the amount of funds we're talking about. So the correlation works. Prime, by the way, the prime rate is one of the lowest interest rates. It's considered pretty much the lowest interest rate an individual can typically borrow. So it's a very aggressive interest rate, very low, always. And if you're borrowing at prime minus something, that's strong, okay? So the positive arbitrage has historically been there. In fact, one of the companies has sent me the spreadsheets and the history of the dividends and the interest rates that were charged for the last 40 years. That's 40. And folks, in those last 40 years, the dividends that were earned minus the interest rates that were being charged was a positive arbitrage every single month except for 2 months of the past 40 years. Folks, every single month except for 2 months in the past 40 years, you had a positive arbitrage situation. And guess what? What about those 2 months? They happened to be equal. In other words, you weren't being hurt. So based on history, based on historicals, based on the interest rate correlation and all of those things, not only is the positive arbitrage powerful, such a powerful aspect of the Your Personal Bank concept of earning more than you're getting charged when you access the funds to use those funds. Remember, it's on funds you have spent. It's on money you have used or allocated or invested elsewhere. Look, if you just leave it alone, I get asked that sometimes. If you leave it alone, you're going to get the 5, 7, 5, 6% dividends today? Yes, of course. But if you take the money because, well, does anyone ever spend any money? That's kind of a obvious question. We all do, don't we? So if you spend some money, you have a choice. You can spend it. You can use those dollars and you can buy things. You can pay off debt. You can invest in things. Or why not consider gaining positive arbitrage? And historically, 2-3% is the norm. Gain an additional interest rate on your money that you are spending or buying stuff with or investing or paying debt off. Any of those things. See, to not do that, frankly, is giving up an opportunity. It's giving up interest. You're giving money away. You're throwing money away each and every month, each and every year that you could be putting into your pocket. It's your choice. I can't force anyone to do this. But when I show them the difference, in most cases, it becomes immediately obvious why you should do this. Why not pick up the positive arbitrage? Why not pick up the extra interest? I'm not telling you to do anything different than you're already doing. But if you don't, you're just walking away from it, aren't you? Stay tuned to the next segment. We're going to talk about this further, so don't miss it. Welcome to the Your Personal Bank Show. I was really talking about, in the last segment, if you missed it, I was talking about, look, we all spend money, right? We all invest, or most people do. How's that? Nearly all of us pay off debt or pay debt at some point or another. And pretty much all of us spend money, purchase things. We buy things, right? Because there is a cost to live. We eat. We have clothes on our back. We have shelter. There are things we spend money on. And pretty much all of us do that. And the funny thing is, this is what I find interesting. I share this concept with people all the time. If you've been listening, you know I've been traveling around the country the last, 7 or 8 years up to COVID, speaking to different investor groups about how to enhance their returns on their investments. I've been on the radio now for a couple of years sharing this whole concept. So I've spoke to many, many folks. Many of those are clients today, of course. But what I find is interesting is how so often people, I guess what I'm trying to get at is, why doesn't somebody do this? And I've kind of struggled sometimes answering that question, because if you understand that you put money into a policy to earn dividends, and then you access those funds through a bank line of credit, and when you do that, you gain positive arbitrage. In other words, you pick up extra interest on money, money you were spending anyway, right? When somebody goes out and invests in something or buys an item or buy, normal spending or pays off debt, am I telling them to do those things? No, not necessarily. Many times they've decided to do those things before meeting me. Why? And I always say to them, look, when you are considering purchasing something or investing in something or paying off debt, I always explain it this way. I say you have two choices. You can just pay off, use your money and do those things, pay off the debt, invest, whatever it is. Or you can fund it into a policy to earn dividends, access it through the bank line, and pick up positive arbitrage, which means you will have more money in your pocket, right? I mean, it's basically, that's the bottom line. When you pick up positive arbitrage, that's interest on money, again, on money you spent. That's extra money in your pocket that you would not have had any other way. So I find it interesting. Most of the time people get it. And most of the time when I explain this to folks, I meet with them. Like I said, no cost or obligation. Contact me at yourpersonalbank.com. You can schedule a free, no obligation consultation. We can meet online, whatever. But my thing is, I find it interesting. It used to, many years ago, used to frustrate me a little bit. I'll be honest. I'll be frank with you. We'll put it that way. When I was younger, a little more, less impatient, or less patient, I should say, matured a little bit. You gain some wisdom over time, right? But when I would explain something like this that I just absolutely knew for a fact, it made financial sense to them, and they still wouldn't follow through, whatever that may be. It used to frustrate me. And one time my wife said something to me years ago, and it just rang true. It made sense to me. She says, look, you can't argue logic with emotion. You can't argue with emotion with logic. In other words, the decision that the person was making, oftentimes it was logically made absolute sense. There was just really it was a no-brainer. You know what I'm talking about. It's one of those no-brainer decisions. But they wouldn't make the decision or pull the trigger for emotional reasons. And those emotional reasons can vary significantly. There's a whole gamut. We've all heard the stories, and we know, and probably have experienced personally, the stress and the anxiety, and sometimes when it comes to money and making the right decisions. I mean, that's kind of normal part of human existence, right? So I get it. But I do find it odd sometimes. See, I find it, in fact, maybe I should, I don't know if I should say this or not, but just being straight with you, I kind of feel sad for people a little bit when I share this idea with them, explain to them, lay out a plan where basically mathematically it's going to put more money in their pocket than what they're already doing. Because when you pick up positive arbitrage on money you're spending, because they were planning to invest in something or take some money and invest into it or pay off some debt or whatever, or buy something, and you pick up positive arbitrage, which means you're just going to have more money, right? And they don't do it for whatever reason. Like I said, the vast majority do, but some don't. I find it, I found myself, I feel a little bit sad for them. In fact, I feel sad because I feel a little bit responsible, because I recognize that this is a paradigm shift in thinking about money. And this is something that's very much a specialty. Very few financial folks deal with the personal bank concept. Very few insurance agents do. Very few financial folks, CPAs, attorneys, any of them. So I'm in a small specialty group. I get that. So when somebody doesn't follow through for whatever the reason is, I feel sad, because I recognize the odds of them running across this again a second time are pretty darn minimal. And it's pretty unlikely that they're going to get the chance to look at this again and gain a better understanding of truly how powerful it is and how it would really change not only their financial future, but who I guess I feel the most sorry for is the next generations. Because if you understand compound interest, and you understand how you put compound interest together with positive arbitrage on dollars spent, I mean, you can be talking about massive amounts of money, generational money, changes of generations, financially speaking. So I guess sometimes I feel a bit of a burden, a bit of a passion, I guess, because I really do want them to understand. Look, I'm not pushy about it or anything like that. Anyone who's ever worked with me knows that. But I do have a passion, because I understand the impact that this absolutely will make in someone's life. Again, positive arbitrage on dollars you've spent means you're going to have more dollars in your pocket. Look, those dollars were going to go out the door anyway, right? You spent them for whatever reason. Why not pick up some interest on that? See, that's the part that gets me. It's like, if you have the opportunity to pick up some interest on that, why wouldn't you? And it really does come down to emotional reasons that make no sense, have no logical, they just don't make any logical sense, right? So sometimes you just can't fight the emotion. It's the comfort zone, or this is the way I've always done things, or whatever the reason may be. There's so many different things. But please understand, this is generational, life-changing. This can make an impact. When you add compound interest to the picture, when you add that to the positive arbitrage, I should say, with compound interest, you put those two together, it gets really interesting in terms of how much more money somebody has in their pocket. And really what they're doing now is they're taking control of their financial future, aren't they? And that's why I think, particularly today, that's so valuable, so important, is for people to rely on themselves and their families and not other outside entities, if you know what I'm trying to say. Take control. Don't rely on the government. Don't rely on your company to take care of you. Don't rely on, well, just about any other institution out there, right? Because who's going to do the most to take care of you and your family? You or someone else? See, that's powerful. And if you can make your money go farther, if you can compound it and you can earn more even on dollars you spent and ensure you're going to have more, that will make a difference. Stay tuned in the next segment. We're going to talk about more about how this has made a difference in some other people's lives, so don't miss it. Welcome back to Your Personal Bank Show. I think I really want to stick to this topic and this thought that I started in the last segment about why don't people do this? When they first look into the personal bank concept, it's intriguing for a lot of people. It's different. I like what some of the several radio stations have shared with me when they first want to bring me on as a show, the content. They just love it because the comments I get from the station managers and various people is they're like, this is so new, it's fresh, it's different. And I kind of laugh. I say, well, it may be fresh and different. It's definitely not new. This concept's been around for decades and decades, okay, if not longer than that. But it is new to the average American, absolutely, because we've talked about this so many times. This is very common in the corporate finance world, the bank world, institutional investors. It's just not common in our industry, what's called the retail world. And that's where the average American resides. And a good rule of thumb, folks with 10 million liquid and less kind of falls into the retail category. It's not hard and fast, but that's sort of the rule. And most financial advisors, most CPAs, most attorneys for that matter, any of those, don't spend the majority of their time practicing or working with clients in that realm, okay? Some do. There's a handful. I mean, there's a very, very small percentage that do, but the vast majority don't. They're dealing with the average Americans. And therefore, those advisors are typically not introduced to this concept. They're not familiar with it. It's not shared very often. And that's part of the passion of this radio show, because when I was first introduced to this concept, I was like, why isn't this shared more often? Why don't more people know about this? And there were various comments by I was in a seminar training thing by the trainers, and they said, well, for one, obviously something that's tax-free appeals to someone who's a higher income earner, higher tax brackets. I said, well, that makes sense. But the thing is, if you could save a high income earner, say $10,000 a year in taxes, that they're going to be happy about that, of course. But somebody who's on the lower end of the spectrum, maybe you save them $1,000 in taxes, you might be making an even bigger difference for them. And of course the trainers agreed and all that, but then they said, well, the other part of it is deals with commissions and the time. It takes the same amount of time to put together and plan and set up and market a large case and a small case. And of course the bigger dollars involve bigger commissions. And I said, well, that's obvious. That makes sense. I was in a somewhat unusual situation when I was introduced to this. I was fortunate because I owned an agency where we had about 4,000 clients at the time. We had been doing the dinner seminars and doing the IRA, 401ks, retirement planning kind of stuff for years. So we'd built a large clientele, and we were, of course, reviewing those clients on a regular basis. So my thought was, we're meeting with these folks anyway. How hard would it, about their financial picture, how hard would it be really to introduce a new idea to them where they could gain positive arbitrage, where they could reduce their income taxes, where they could increase their liquidity, create a fund where they had monies available for long-term care expenses if they needed, and a death benefit to boot for their loved ones if something happened to them prematurely. Well, guess what? We found out it was really easy. In fact, we found out, this is what was interesting, is I've always, for most of my career now, well over a dozen plus years now, I've worked exclusively with folks with their referrals or someone who attended one of my workshops or now the radio. I just haven't, I've been fortunate that I haven't had to go out and, pursue prospects, so to speak, prospective clients. And so what I found out though was, so I've always worked with a lot of referral business. Okay. This product though, because it was new and fresh and different for most of the people we were introducing this to, and it accomplished so much more for them than what they've been receiving with their money or what their money had been doing for them, they were ecstatically recommending that we talk to their brother and their cousin and their business partner and everybody else for that matter. In other words, referrals were just getting thrown at us without us even asking. And that still happens today. People, generally speaking, most of the time when I talk to them, then they recommend me to other folks they know too. It's very, very common. Most of the time, long before I ever ask them, because they see the benefits. They see how powerful they understand that earning positive arbitrage, earning interest on money you spent, means you got more money in your pocket. It's just that simple. And when you understand that, you understand the power of this concept. So I'm going to encourage you to stay tuned in the last segment. I'm going to discuss a few other situations where, frankly, we're able to change the financial future of people or show them how to do that. It's pretty exciting. So stay tuned. Don't miss it. Welcome back to Your Personal Bank Show. And we've really been talking about the reasons why people don't move forward with the personal bank concept once they do actually look into it. I mean, obviously, a lot of people just have never been exposed to the idea, or it's new, or it's different, and they just don't really understand what it's about or what it could do for them. But what I'm talking about more is about the people once they do look into it. And like I said, there's a lot of emotional reasons behind it. Like I said in another previous segment, you can't argue emotion with logic sometimes. It just, even though logically makes sense on every level for that person, sometimes the emotions get in the way. And we always don't make the right decisions for ourselves. I mean, that's human nature, right? We're human beings. We make mistakes. And money and people don't always mix real well. There's a lot of issues and anxieties and various other things, fear of missing out, fear of making mistakes, whatever, all kinds of fears, right? Involved with money. And there's opportunities too, but I'm not even talking about that. Some of the things that, that does happen, of course. Fortunately, not too often, but it does. But some of the other things I'll often hear from people, they'll say things like, well, I'm too old. That's maybe one of the most common ones I get. Last month, I qualified a couple, they aged 74 and 78, and the numbers worked out great. And they're using this to supplement their retirement. Because like I said, if you heard in the previous shows, I shared this, they had actually funded an annuity because they wanted to guarantee additional income. And annuities can be a great fit for that kind of situation where somebody wants to just ensure a guaranteed income the rest of their lives. But when the husband heard about this on the radio, and then we met, we talked about it, we ran the numbers, I showed him where his income would be larger, greater, more than the annuity would offer. Secondly, it would be tax-free instead of being tax deferred or taxable when he took it. So that's better, less taxes, right? Also, he really, really liked the fact it was far more liquid. In his case, had about 85% liquidity day one. And the annuity, of course, only offered like 10% liquidity day one. So we had all those factors. And then when we added on top of it, we set up, like I said, a policy on his and hers. There was a reciprocal benefit in terms of funds available for long-term care if either of them needed it. And look, if they needed it, they had it. And if they didn't, they didn't pay extra for it. So really, what can be better than that, right? So that was a major positive. Lastly, there was because we put a policy on his and her, there was a married couple, reciprocal death benefit. So if either passed away, the survivor would get a nice tax-free death benefit check that would replace or significantly replace the lost Social Security income. So the annuity wouldn't do that either. So there was 4 or 5 reasons that were superior to the annuity. And this is for a couple in their 70s. The fact is, more folks, in my opinion, that are retired should look into the personal bank as a retirement supplement tool rather than things like annuities because of so many significant enhancements, right? Like I said, much higher liquidity, tax-free versus tax-deferred. Money's available for long-term care if needed, and a death benefit available will be there for the surviving spouse that can replace lost income like Social Security. Those are some great reasons, okay? The other one I get, though, is, okay, well, like I said, they're, too old. Well, like I said, they're in their mid-late 70s. Obviously, if somebody's health is really poor or something like that, maybe they can't accomplish this. So that could be a reason why not, okay? I get that. But there's always plan Bs. We can put these, trust. We can have entities on them. We can have you can have in-laws or kids be the owner. You're the funder. I mean, there's so many different things we can do to make it work anyway. That's not really a good. It's not a really good reason to not look into it, I should say. Another one I hear all the time, quite often, is, well, what's the cost of insurance and all that? Okay, fine. First of all, if you've been listening to the show at all, you know that we are setting these up to maximize cash value and minimize the death benefit, which is the opposite purpose of how most people view and use life insurance. I always say to people, look, everything you know or understand about life insurance, turn it on its ear. It's probably the opposite of what you think. You've got to just totally reverse everything. Because, again, we're trying to maximize cash here, not maximize the death benefit. In fact, we're doing the opposite. We're minimizing the death benefit as much as allowed by tax rules. The thing is, by reducing the death benefit by anywhere from 50 to 85%, depending on how we structure these and what kind of funds you have to work with to fund these, right off the bat, you're reducing the cost of insurance by 50 to 85%. I mean, that just makes logical sense. Most people get that. So right out the gate, we're dramatically reducing the cost of insurance, which for a lot of people, that's their main hitch, if you will, their main reason why they think it doesn't make sense or shouldn't look into it. Well, get that out of your head, because that's not a good reason, because we're dramatically reducing the cost of insurance. By dramatically reducing the amount of insurance, we're maximizing the cash. And in fact, that's the other question I get. Well, how much am I going to have to pay into it for the insurance? Well, guess what, folks? A small portion of the dividends that you earn, because we're doing so much into the cash side, we're growing so much cash, a small percentage of the dividends are used to cover the cost of insurance. So what's your out-of-pocket costs? There aren't any. So that's another part that people kind of get a little, and that, the light bulb starts to come on. Let me give you another one. Remember, the key facet of this tool if you want to grow the money, earn dividends consistently, get some tax benefits, some safety and all that, and just let it ride, can you do that? Certainly. And use it as a passive investment? Absolutely. But if you want to maximize its capability, then you set up the bank line of credit. And you access, when you do spend money or use money, you access it through the bank line, because you get the lower cost of borrowing. Your cost of borrowing is less than the dividends you're earning. In other words, you're keeping the positive arbitrage. You're gaining the difference. You're keeping the difference, right? Like I said, most people right now, it's about 2.5%. And historically has been that, as I stated in the first segment. If you missed it, go back to yourpersonalbank.com I encourage you to check it out further, and you'll see what I'm talking about. And you listen to any of the previously recorded shows there. But what my point I want to get at right now is, as far as, well, how should I say it? Let me put it to you this way. People get kind of hung up on the whole idea of debt. And they say, well, I don't want a bank line of credit because I don't want to owe a bank any money. Now, I get that. I understand. I'm negative to debt also, very much so. And if you know my story, you'd understand why. That's for another day. But the thing, and there's people out there that teach getting out of debt, out of debt, out of debt. Okay, I get all that. I understand. But here's one thing I want you to understand. There is a difference between consumer debt and strategic debt. And what do I mean by that? We have to define the debt. Strategic debt, for example, is debt where somebody else is covering the cost of the debt for you. Something else is covering it. And a great analogy many people are familiar with is if, for example, if you bought a rental house and you had a mortgage on that house and the rent was covering the mortgage and then some, you would make profit, right? In other words, the renter is paying the mortgage on the property, right? And you get the positive arbitrage. You get the difference. That's what profit is, positive arbitrage. You keep the difference of the cost of the mortgage and expenses. The rent you earn minus the cost of the mortgage and expenses is the difference you keep. Plus, there's appreciation and other things. But to keep things simple, that's positive arbitrage, okay? And you're taking on debt to do it. You borrowed money from a bank to buy the house, right? Can you build wealth that way? Well, the answer is obvious. I mean, there's a myriad number of stories of people building wealth through real estate, okay? You can do the same thing here. You can build wealth by using positive arbitrage, keeping the difference, okay? So all debt is not necessarily bad. In fact, positive arbitrage that's created by earning more in dividends and you're getting charged at interest can create wealth and does. And so keeping on that thought about the debt thing, a lot of people say, well, okay, well, I'll have to pay interest to the bank. Well, the answer is not necessarily. Now, should you pay the interest to the bank? Well, of course, if you can, by all means do so, because if you borrow money from the bank line, what's happening? Remember, are you taking, I always ask this question, help people understand. Are you accessing the money from the bank or the insurance company? In our example here. And the answer is the bank. In other words, you funded the money in the insurance policy to earn dividends, right? You're getting paid dividends every single year. You don't touch that. You let that grow. You just let that grow compounding. So there's more and more money in that, more and more cash in that policy every single year, right? When you access money, you access it from the bank line. Now, if you happen to pay the interest, which by the way is less than the dividends, so you get the positive arbitrage, but if you happen to pay the interest each year, well, would your debt go up? And the answer is no. The amount you owe would stay the same with the bank, wouldn't it? The cash in the policy, though, keeps compounding, which means it's growing faster and faster and faster, which means you have more and more money. By the way, there's a common misconception or question is, yes, the bank line increases with the cash. Depending on your credit score, your cash available is going to be between 95 and 100% of the cash available in the policy. So when the cash increases, so does your bank line, which means you got access to more money, don't you? Straightforward, pretty simple. Now, what if you were in a situation where you were unable to pay the interest even? You accessed the money through the bank line, but you couldn't pay the interest. Or maybe you don't want to. Will it still work? And the answer is yes. In fact, this is a situation I'm working on recently. I won't say which bank, but a bank executive who is, and his wife, who actually do trading. They have a trading account, and it's highly liquid, and they've decided they want to fund these monies into the policy. Why? Because the banker understands positive arbitrage. Look, bankers understand positive arbitrage probably better than anyone. If you have any question about this, you should be asking a banker, not a financial advisor or a CPA or an attorney. No offense against any of those people. But if you want to learn about positive arbitrage and compound interest, talk to a banker. They get it. And, bankers know how to make money, don't they? I don't think anybody can argue with that. Here's my point. They understand the positive arbitrage. So literally, they can either keep that money in that trading account and keep trading in the stocks and options and various things that they're doing, or put it into the policy, access the funds through the bank line of credit, and now trade their stocks and options and various things with most of the money, and also pick up positive arbitrage. In other words, they're going to get a return on the money whether the stocks or options produce or not. Look, if you can get your money to work twice for you instead of once, doesn't that make sense? And that's what I was saying before. Why don't people do this? Like I said earlier, there's a lot of reasons, and a lot of them happen to be emotional. But the reality is, if you truly understand, and maybe the other reason is, folks just don't fully get it. They don't fully understand how they can really get their money to work twice for them. Folks who are successful get it. Folks who understand money get it. Folks who understand positive arbitrage and compound interest do get it. And that's the majority. But that's what I would want to say to you is, look, if you can get your money to work for you twice versus once, why wouldn't you at least consider it? Why wouldn't you look into this? And you heard earlier in the show, I don't think you're too old and don't think there's too many fees or costs. We minimize all those and understand you can create positive arbitrage and get your money to work for you. If you want to use it to invest, make it work for you twice rather than once. Doesn't that make more sense? Isn't that more efficient? It just makes logical sense. So like I said, as always, contact me at yourpersonalbank.com for more information. And you can set up a no-cost, no-obligation consultation. Or as always, stay tuned to the Your Personal Bank Show.